For thousands of years, people have loved silver. We have used it to make beautiful jewelry and shiny coins. For a long time, silver was real money in many parts of the world. It was a safe way to store wealth and protect your family's savings. But today, in 2026, silver is much more than just a precious metal. It has become one of the most important industrial commodities on the planet. Its role has expanded far beyond what our grandparents could have imagined. Silver is a critical ingredient in the modern technologies that power our daily lives, from the phones in our pockets to the cars we drive. Silver has unique properties that make it irreplaceable. It is the most electrically conductive of all metals, meaning electricity flows through it with very little resistance. It is also the most thermally conductive metal, which allows it to move heat very efficiently. These special qualities make it essential for electronics, solar panels, electric vehicles, and countless other high-tech applications. Without a steady supply of silver, many of the green energy and technology goals that countries have set for themselves would be nearly impossible to achieve. This makes silver a strategic metal, vital for economic growth and national security in the 21st century. Because of its dual role, silver stands in a unique position. It is both a monetary metal, like gold, that people buy for financial safety, and an industrial metal that gets used up and consumed by factories. This dual demand creates a fascinating dynamic in its market. When people are worried about the economy or inflation, they often buy silver coins and bars. At the same time, industries are constantly buying silver to build the products of the future. The supply of silver, however, is limited. We can only mine so much of it each year, which sets the stage for a potential conflict between these two powerful sources of demand. Understanding this dual nature is the key to understanding silver's price. Its value is not just tied to what investors think it is worth as money. It is also directly linked to the health of the global manufacturing and technology sectors. In recent years, the industrial side of the equation has grown dramatically, putting immense pressure on the world's available supply. This is a new development that is fundamentally changing the silver market. The story of silver in 2026 is the story of this incredible industrial demand colliding with new and powerful constraints on its global supply, creating a situation unlike any we have seen before. On January 1, 2026, the global silver market changed overnight. On that day, the government of China put new rules in place that strictly control who can export silver from the country. This was not a small adjustment. It was a fundamental shift in policy. For years, China used a quota system, but the new rules are much tougher. They created a strict licensing system. Any Chinese company that wants to sell silver to other countries must now get a special license from the government. This gives Beijing direct control over how much silver leaves its borders and where it goes. To get one of these new export licenses, a company must meet very demanding requirements. First, it must prove that it produces at least 80 tons of silver every single year. This is a huge amount that immediately disqualifies many smaller and medium-sized refiners. Second, the company must have large lines of credit, around $30 million, to show it is financially strong. Finally, it must have a perfect track record of exporting in the past. These rules are so strict that for the 2026 to 27 export period, only 44 companies in all of China were able to qualify. Everyone else was locked out of the international market. This move is not new for China. The government has used similar tactics before with other important materials. In the past, it has restricted the export of things like rare earth elements, tungsten, and antimony. These are materials that are crucial for making everything from magnets in wind turbines to advanced military equipment. By controlling the supply, China was able to ensure its own factories had enough, and also gain a powerful tool in international trade. Now, China has officially added silver to this list of strategic metals, signaling that it sees silver as vital for its own future. The reason for this change is clear. China wants to keep its silver for itself. The country is the world's factory for solar panels, electric cars, and advanced electronics. All of these industries need massive and growing amounts of silver. By restricting exports, the Chinese government is making sure that its domestic high-tech industries will have a secure and stable supply of this critical metal for years to come. This policy prioritizes China's own economic and technological ambitions over the needs of the rest of the world, and it has sent a shockwave through the global silver market. To understand the impact of China's new rules, you have to understand its huge role in the global silver market. China is not just a major silver miner, It is the world's most important silver refiner. For many years, China has imported raw silver ore and concentrate from mines all over the world. It then refines this material into pure investment-grade silver bars. After that, it has historically exported a large portion of this refined silver back out to the global market. This made China a critical hub in the silver supply chain, processing raw materials and feeding pure silver to other nations. The numbers are staggering. Before these new rules, China was responsible for an enormous share of the world's refined silver supply. Some estimates suggest that between 60 and 70% of all the refined silver available for international trade passed through China. Think of it like a giant processing plant for the entire planet. Countries would send their raw silver to China, and China would send back the finished product. This system worked for years, but it also made the world heavily dependent on China's willingness to keep exporting. Now, that willingness has changed, and the global market is feeling the consequences. The new licensing system effectively turns off this tap. By sidelining hundreds of smaller refiners and putting strict controls on the few large ones that qualified, China could drastically reduce the amount of silver it sells to the world. Analysts believe this policy could remove a huge portion of the supply that countries like the United States, Japan, and India have come to rely on. In 2024, China's silver exports were valued at $3.8 billion. A significant cut to that number creates a massive hole in the global supply chain that cannot be easily or quickly filled by other countries. This policy shift creates an immediate problem for every country that needs silver for its industries. Suddenly, a major source of supply is being choked off. This is not a distant future problem, it is happening right now. The global market, which was already struggling with a supply deficit, now has to deal with its most important refiner deciding to keep its product at home. This act alone is enough to cause major disruptions and price increases, as nations and companies scramble to find silver from other, smaller sources. It is a game changer for the entire silver market. At the same time that China is squeezing the silver supply, another major change is happening in the world of banking. This change is called Basel III. These are a set of international banking rules that were created after the 2008 financial crisis to make the global banking system safer. The goal is to prevent another massive crash by making sure banks are not taking on too much risk. The rules are very complex, but their effect on precious metals like gold and silver is simple and powerful. Basel III changes the way banks think about holding real physical metal. One of the most important parts of Basel III is how it classifies different assets that banks hold. An asset is anything of value that a bank owns. Under these new rules, physical gold and silver that is fully allocated, meaning it is real metal stored in a vault and owned directly by the bank, is now considered a Tier 1 asset. This is the highest and safest category of assets a bank can hold. In fact, it is given a 0% risk weighting. This means that, in the eyes of regulators, holding physical gold and silver is now just as safe as holding cash or government bonds. This is a huge change from the old rules. Before, physical metal was seen as a riskier asset. Now it is treated as a core part of a bank's safest reserves. This gives banks a strong incentive to buy and hold real physical silver in their vaults. It helps them meet the strict new safety requirements set by Basel III. Instead of being a speculative commodity, physical silver is now officially recognized as a top-quality reserve asset. This encourages banks to become buyers of physical metal, adding a new and powerful source of demand to the market. The implementation of Basel III has been happening in phases around the world for several years. Different countries and regions are adopting the rules on slightly different timelines. For example, the United States is working on its final endgame adjustments, while the United Kingdom is set to fully implement its version by 2027. But the direction of travel is clear. The global banking system is slowly but surely moving towards a framework that makes holding real silver much more attractive and holding paper silver much less attractive. This regulatory shift is a quiet but powerful force pushing up demand for the physical metal. While Basel III makes holding physical silver more attractive for banks, it does the exact opposite for what's known as paper silver. Now, paper silver refers to contracts and financial derivatives that are linked to the price of silver, but they're not actually backed by real physical metal on a one-to-one basis. For decades, large banks have been able to create and trade, honestly, huge amounts of paper silver, often way more than the actual amount of real silver that even exists in the world. This system allowed banks to influence the price of silver without ever having to handle the physical metal itself. One key part of Basel III, called the Net Stable Funding Ratio, or NSFR, makes this whole paper-silver business a lot more difficult and expensive for banks. The NSFR requires banks to hold a certain amount of stable funding to back up their assets. For unallocated precious metals accounts, which is the technical term for paper silver, the rules impose a really high 85% required stable funding factor. In simple terms, what this means is that it's now become very costly and risky for banks to hold large, unbacked positions in the paper silver market. These regulations, well, they basically penalize those fractional reserve paper games. This pressure from the NSFR is forcing banks to change how they operate. To avoid those high costs and risks, banks are now incentivized to reduce their exposure to paper silver. For banks that have large short positions, so bets that the price of silver will go down, this means they may actually be forced to buy physical silver to close out those positions. This process of covering shorts creates a huge amount of buying pressure in the market. It turns banks that were previously pushing the price down into, desperate buyers, pushing the price up as they rush to secure the real metal they suddenly need. The effect of this is a massive squeeze on the paper silver markets, like the COMEX futures market in New York. These markets have, for a long time, operated with a huge gap between the amount of paper claims and the amount of physical silver available for delivery. For years, this didn't matter much because very few people actually asked for the physical metal. But as Basel III makes paper positions more painful for banks, and as more investors demand delivery of real silver, the weakness of this paper system is finally being exposed. The rules are pushing the market back toward physical reality, and that reality is one of, very tight supply. What is happening in the silver market today is honestly incredibly rare. It is not just one factor pushing up the price. It is actually two powerful and independent forces working together at the exact same time. Analysts are calling this the double squeeze. On one side, you have China's new export restrictions, which are dramatically reducing the amount of physical silver available to the rest of the world. This is what we call a supply-side squeeze. On the other side, you have the Basel III banking regulations, which are pushing banks away from paper silver and forcing them to buy physical metal. That is a demand-side squeeze. So, imagine a tube of toothpaste for a second. China's policy is like someone squeezing the tube from the bottom, limiting how much can come out. At the same time, Basel III is like someone squeezing the tube near the top, trying to get more out than is available. When you squeeze from both ends, the pressure in the middle builds up very quickly. In the silver market, that pressure is being released in the form of much higher prices. These two events are completely separate, but their combined effect is creating a perfect storm for the silver market, unlike anything seen in modern history. The evidence of this double squeeze is already clear in the market's behavior. In the first few weeks of January 2026, after China's rules took effect, the price of silver surged to record highs, briefly touching nearly $90 per ounce. We are also seeing a huge difference in prices between different parts of the world. In physical markets like Shanghai, premiums for silver have soared, with prices trading more than 12% higher than the benchmark prices in London or New York. This shows a desperate scramble for real physical bars in the East, where supply is now being hoarded. This situation is very different from past silver rallies, like the one led by the Hunt brothers in 1980. That was driven mostly by a few wealthy speculators trying to corner the market. Today's squeeze is not being driven by speculators. It is being driven by fundamental, structural changes in both supply and demand. You have a sovereign nation, China, deciding to hoard a strategic metal. And you have global banking regulators forcing a shift from paper back to physical. This is a much more powerful and sustainable foundation for a major price move. The intense pressure from the double squeeze is causing a visible drain on the world's silver inventories. For years, large warehouses in places like London and New York have stored hundreds of millions of ounces of silver. These stockpiles acted as a buffer for the market, helping to balance supply and demand. But now, that buffer is disappearing at an alarming rate. The relentless demand from industries and investors, combined with the new supply shock from China, is pulling physical silver out of these vaults faster than it can be replaced. This is a clear sign that a serious physical shortage is developing. The numbers tell a frightening story. The global silver market has been in a structural deficit for 5 years in a row. This means that every year since 2021, the world has consumed more silver than it has produced from mines and recycling. In 2025 alone, the shortfall was estimated to be nearly 250 million ounces. For years, this deficit was filled by drawing down the existing stockpiles, but you can only do that for so long. Eventually, the stockpiles run low, and that is the point we are reaching now. The well is finally starting to run dry. We are seeing this drain happen in real time at the major exchanges. At the COMEX in New York, which is one of the most important silver trading hubs, registered inventories have been falling steadily. These registered bars are the silver that is available to be delivered to buyers who stand for delivery. In one shocking period in late 2025, buyers demanded and took delivery of over 60% of all the registered silver in the COMEX vaults in just 4 trading days. This kind of massive physical removal shows a deep lack of trust in the paper market and a desperate rush to secure the real metal. The situation is even more critical in other parts of the world. In Shanghai, silver inventories have reportedly fallen to their lowest levels in over a decade. This is happening at the very center of global manufacturing, where the metal is needed most. As these visible stockpiles get drained, it becomes a self-fulfilling prophecy. The lower the inventories get, the more panic it creates, and the more people and companies rush to get their hands on the remaining supply. This is how a supply squeeze turns into a full-blown crisis, leading to empty shelves and skyrocketing prices. While the supply shocks from China and Basel III are new, the foundation for this silver rally has actually been building for years. The single biggest driver is the relentless and ever-growing industrial demand for silver. This is not the speculative demand of investors, but the consumptive demand of factories that buy silver, use it in a product, and effectively remove it from the market forever. Today, this industrial use accounts for over 60% of all silver demand, and it is concentrated in the fastest-growing sectors of the global economy: green energy and high technology. The solar panel industry is a perfect example. Silver paste is printed onto photovoltaic cells to conduct the electricity they generate. The solar industry now consumes over 200 million ounces of silver every year. China, which is restricting its silver exports, also happens to dominate about 80% of global solar panel manufacturing. To make matters worse, the newest and most efficient solar cells, known as TOPCon cells, require about 50% more silver than the older technologies they are replacing. So as the world rushes to build more solar farms, the demand for silver from this one sector is exploding. The electric vehicle revolution is another huge source of new demand. Silver is used in almost every electrical connection in a car, including switches, relays, and the battery pack itself. A typical battery-powered EV uses between 67% and 79% more silver than a traditional car with an internal combustion engine. As governments around the world push for a transition to EVs, and as China continues to lead the world in EV production and sales, the amount of silver needed by the auto industry is set to soar for decades to come. Finally, the boom in artificial intelligence is creating another wave of demand. AI requires massive data centers filled with powerful servers. Silver's unmatched electrical conductivity makes it essential for the high-performance semiconductors and other components inside these servers. As companies like Google, Amazon, and Microsoft race to build out their AI infrastructure, their need for silver will grow exponentially. This industrial demand from solar, EVs, and AI is a powerful, unstoppable force. It is a baseline of demand that is not going away, ensuring that the silver market will remain incredibly tight for the foreseeable future. The combination of a historic supply shock from China, a regulatory demand shock from Basel III, and a relentless wave of industrial demand has put the silver market on a path toward much higher prices. The physical deficits are real, the inventories are draining, and the fundamental drivers are stronger than ever before. For these reasons, many credible analysts are now forecasting that silver is on its way to $100 per ounce, and potentially much higher in the months and years ahead. This is no longer a wild prediction. It is a realistic outcome based on the powerful forces at play. The double squeeze has broken the old pricing system. The disconnect between the paper price in New York and the physical price in Shanghai is proof that the market is fracturing. As banks are forced to cover their massive short positions to comply with Basel III, they will have to enter the tiny physical market and buy whatever silver they can find at any price. This could trigger a short squeeze of epic proportions, sending the price on a vertical ascent as there simply is not enough physical metal to go around. A price of $100 would just be the start of this repricing event. For investors and the general public, there are several key things to watch in the coming months. First, keep a close eye on the inventory levels at the major exchanges like COMEX and the Shanghai Futures Exchange. Any further rapid declines are a major red flag that the shortage is worsening. Second, watch the price premiums for physical silver coins and bars. When the premium, the amount you pay over the spot price, starts to rise, it signals intense demand for the real metal. Finally, pay attention to any new policy announcements from China or other governments regarding strategic metals. We are living in a time of profound change for the silver market. Silver is transitioning from being just a precious metal to being one of the most critical strategic commodities of the 21st century. The events of early 2026 are not a temporary spike. They are the beginning of a fundamental revaluation of silver's worth, in a world that needs it more than ever, but has less of it available. The journey to $100 silver will not be a straight line, but the destination seems increasingly certain. The era of cheap, abundant silver is over.